Hi, I'm David Hanna from Cornerstone Tax and welcome to our video on the new 2% non-resident surcharge. From the 1st of April 2021, any non-resident buying residential property in the UK will be liable to an additional 2% surcharge. This is over and above the normal residential rate and indeed the higher rate for additional dwellings. And it's important to understand who does and who doesn't qualify for this additional levy. First, let's be quite clear. This levy, like the 3% surcharge, can only apply if what you are buying is wholly residential and not subject to a lease of more than 21 years. If you are buying a property that has mixed use or is subject to a long lease, then you will not pay this 2% additional surcharge. But if you are buying a property that is liable to it, you then have to determine whether you or any of the purchasers are non-resident. For individuals, if they haven't spent at least 183 days in the UK in the previous 365 days before the date of purchase, then the 2% surcharge will apply. But if they spend 183 days in the 2-year period spanning the date of purchase, then they can apply to reclaim the 2% surcharge. Now, this could be a problem because you may well have a qualifying date for reclaiming the 2% surcharge, and if you've moved to the UK and sold your overseas residence, you could have another reclaim for the 3% surcharge. So recording dates and remembering time limits is going to be critical. The one group that it does not apply to are joint purchasers who are married. So, for example, if your spouse comes to the UK for 183 days and you jointly buy a house for yourselves to live in with the other spouse returning to the UK later, then the 2% surcharge doesn't apply. Now, you might think this is all very confusing, and it's a very complex piece of legislation with its own set of tests, some of which are counterintuitive. But it's important to get the advice early, and also if you're thinking about moving to the UK, plan your arrival or your spouse's arrival well in advance. Now, the most obvious answer to most people will be, well, we'll buy this with a UK resident company. That way we've got a UK resident purchaser. Well, the revenue have anticipated this, and even UK resident companies will pay this surcharge if a majority of the owners, i.e. the shareholders, the participators, are themselves non-resident. And again, there's a piece of anti-avoidance here that allows the revenue to connect resident shareholders to any shareholder who is non-resident and deem them to be non-resident. So you have to be very careful. If you're setting up a property investment company in the UK to invest in residential property, be very careful about who your shareholders are and where they live. So at the moment, the legislation is going before Parliament. We don't expect it's going to be amended, but as you've already heard, its rules are incredibly complex. I expect that law and practice will actually change and develop before the 1st of April next year. And in a future episode, we're going to go into this in a bit more depth and give some real-world examples of people who might be caught and who might not be caught and what they can do about it. Please like and subscribe this video and click on the link below if you want to know more. Thank you for listening.